Good evening and welcome to Money Magazine. I'm Alan Brooknia. The head of the Hong Kong Monetary Authority has announced a new arrangement for the venerable peg, expanding the zone it can trade in. As Douglas George reports, in the long run it could mean higher interest rates for home buyers.
It was expected, but one couldn't say it had been a long time coming. The head of the Monetary Authority hinted something was up only 2 weeks before in LegCo.
In 2005, do we still need such a relaxed currency environment? As far as monetary policy is concerned, I've no choice. If capital keeps coming in, our currency environment will be more relaxed than that in the US. I don't want to see this relaxed currency environment to continue for too long.
In the biggest change to the linked exchange rate system since the stock market intervention, in the torrid summer of speculation in 1998, the folks who managed the peg to the US dollar decided to tinker again. From now on, the link will have an upper limit on the strong side of the 780 peg at 775. Traders will no longer have to guess at what point the MA would start buying US dollars to bring the Hong Kong dollar back down. The MA also set another limit to the weak side of 780 at 785 to add symmetry to the trading range. This limit will move in increments gradually and will finish on the 20th of June. The third measure promises to operate the convertibility zone consistent with currency board principles.
7.75 is not a magical number. It is actually a manifesto from the Hong Kong government for their commitment on the peg, or they are further committed themselves to a real fixed rate regime with two-way commitment.
If you are going to move the weak side support point from 780 to 785, you need to do it when the exchange rate sentiment is quite firm. The officials are becoming fed up with the continuing inflows into the Hong Kong dollar, which are driving down local interest rates and building up liquidity in the banking system.
At one point, the banking system had over $50 billion swirling about and caused interest rates to drop to the benefit of borrowers, companies, and home buyers alike. A wave of money has flooded into Hong Kong, betting that as the mainland's renminbi strengthened, so would the Hong Kong dollar. The MA decided it had better tinker with the link before speculation on the renminbi got the better of the peg on the strong side. The measure seemed to have done the trick. The balance in the banking system has dropped to normal levels, around 700 million Hong Kong. Analysts believe speculators have unwound positions in the Hong Kong dollar, no longer certain they could buy back US dollars at 780. At that level, any possible losses were fixed. But now, as the rate falls steadily to 785, their previous positions have been blown.
These speculators will take a calculation and say, well, I've got more money at risk here, and my head office hasn't allowed me that limit, and I might lose my annual bonus if I stay in this position. So I better close it out today before the rate might start drifting to 785.
The changes this time around are decidedly less dramatic than the last time the peg was adjusted. Then speculators were gunning for the Hong Kong dollar on the expectation it could be knocked from its perch, and in the process manipulated local stock and futures markets, exploiting the fear the Hong Kong dollar could be torn from its fixed rate to the weak side of 780 against the US dollar. Then Financial Secretary Donald Zhang fought back by spending over $100 billion on stocks, foiling the speculators and defending the dollar. So, is the peg still a peg inside a zone, or is it a band with a peg in the middle?
We are not depreciating our currency. In fact, we are trying to work around a more symmetric system.
In the meantime, the banks have also fallen into line rather smartly, with most hiking their primes 0.5% to 5.75%. Mortgage rates are likely to follow, but competition will keep increases to a minimum.
Mortgage rate probably will be settling back to prime minus 250 to prime minus 220 instead of the prime minus 280 situation.
I don't think a move of that scale is going to have a major impact on the economy. The Hong Kong economy is not hugely sensitive to the interest rate movements.
The latter thinks with RMB revaluation still in the offing, speculators are likely to return once they have sussed